What's up guys? In this video we're going to be looking at the complete annihilation of Redbox stock. Let's get started. Now if you're new on the channel you might not have seen it, but a couple days ago, actually no, it was a couple weeks ago, I made a video where I deconstructed Redbox stock, this blockbuster vending machine company with immense losses, immense revenue declines, hardly any money. Just a completely terrible company, and I said it was a terrible company, and people in the comments completely hated that. I got so many hate comments. The dislike ratio, we're gonna check it out. I'm gonna respond to some of the comments in this video, but yeah, I got so much hate for this. Now when I made my video on it, the stock was at about $10. It got up to a high of around $15 just before I made the video, and now it's currently at $3.40. From just a month ago, the stock is down 70%. Now, if you don't know how math works, which I assume you don't if you bought Redbox stock, if you lose 70% of your portfolio, you can't just gain 70% to get back to break even. Here I have a little percentage table to show you how much you would need to break even for different losses and stuff. So if we look at a 10% loss, for example, you'd only need to make 11% to get back up to break even. That's super easy to recover from. That could just happen on any day. If you go down to like a 25% loss, that's still completely fine. It happens all the time. You would only need a 33% gain. So that's not really a big deal either. Now, if we go down further to a 50% loss, you need 100%. We've only doubled the amount of losses, but you need way more gains. So yeah, you would need a 2x basically if you lost 50%. Now we're getting into serious territory, because only if you have a really strong stock can you recover from that. For example, Charlie Munger, that's Warren Buffett's partner. If you don't know, he's down like 50-something% on Alibaba, if I remember correctly. But it's a very strong company, and that's a rare situation. So if you're down 50%, you better have a really strong company, because these are some serious losses. But then if we go down just a little bit more to 70%, you would need a 233% gain. Now this is just getting ridiculous, but what if we go down further? 75%, only 5% difference here, probably not that much. That would change from needing a 233% gain to break even, all the way up to a 300% gain just to break even, from only 5%. And if we go down another 5%, it goes up to 400% gains just to break even. And if you had like a 95% gain, you would actually need 1,900%. That's like basically impossible to recover from. The chance of getting a 1,900% gain is like slim to none for even the best investors. So in 1 month, to lose 70% of your portfolio is completely insane. And that's just from when I made my video. There are a lot of other people that purchased the stock back when it was at $15. And since it's now down at $3, that would be almost a 78% loss on a blockbuster vending machine. And you don't have to be a stock genius to figure out that a company with a negative 39% profit margin selling at a market cap of $500 million, that's basically a blockbuster vending machine with revenue that's being cut in half year after year after year, is a bad investment. It's so easy to tell, but a lot of people cannot see past the meme hype. And it was even trading far above the price it was being acquired for. So even other companies wouldn't pay this much for it. The price was destined to go lower. So yeah, it's not even remotely surprising if you know how to read financial statements, or you just have common sense, that this stock shouldn't be trading at what it was. In fact, I wouldn't pay anything for this stock. This is completely terrible, unless I was doing like an arbitrage deal on the acquisition or something like that. But again, if you're paying above the acquisition price, that's not gonna work out very well. Now let's go through some of the comments, because like I said, I got an extreme amount of hate for this. But here's one excellent, very juicy comment. I'm not gonna include the names of any of these just to avoid any embarrassment for the people that wrote them. But here's one that says, just like GameStop, this company is going to transition into a different company, which is going to be a streaming service. No joke. Redbox streaming service. So I assume this is going to be like Netflix, how it used to be, where they just license random content, which hasn't really worked. You can't really have that kind of a business model when every company that makes content has their own streaming service. So how is this going to work for Redbox? And then this is the best part. They say by the end of the year, it'll be almost $30 a share, which I don't think is happening. It has only been 3 weeks though. So, you know, it could 10x by the end of the year. Possible. You have some comments that say, I don't know how technical analysis works. I don't know what that has to do with Redbox stock. A lot of the thesis behind Redbox is that it's going to be like a different company or whatever. I'm not talking about trading. You can trade any stock. It doesn't matter what the company is doing, but it's not really the best way to make money. Even Warren Buffett doesn't really do trading. He used to do a lot of technical analysis and stuff back when he was just starting out investing. It's not really a great way to make money. It can be done, but it's not ideal. But yeah, in that case, if you're trading Redbox, you can trade Redbox. I don't care. I wouldn't have anything to offer to that. I don't know how to do technical analysis. It's just kind of inferior to long-term investing, actually valuing companies as a business. So yeah, I mean, I don't have a problem if you do technical analysis, but that's not really what this video was about. And now I know you can't see the dislikes on YouTube, but I'm actually going to share because they do keep count. The dislike button does show the creator how many dislikes it has, or not the number of them, but the ratio. And this has a 33% like ratio, like the dislike ratio. So if it was only likes, it would be 100%. And if it was only dislikes, it would be 0%. So yeah, 33% mostly dislikes on this video where I said not to buy a $500 million blockbuster vending machine company with negative 39% margins. So yeah, pretty insane here. And this is just after a month, so we'll see how far it goes. It could go down to maybe $2, $1, we'll see. So yeah, I'll definitely be keeping an eye on Redbox stock. It's down almost, actually over 10% just today. So almost 25% down in the last week, 70% down in the last month. It's like a straight line, pretty epic. Just wanted to point that out in case you thought that Redbox was a great company and it was a buying opportunity. Definitely not, unless you're doing something with the arbitrage deal. But yeah, most people probably aren't if they're buying it at $15. So if you dislike this video, make sure you smash that dislike button. If you like this video, make sure you smash that like button. Maybe we can beat our last Redbox video of getting 33% dislike ratio. Maybe we can get like 25, 20, 13, something like that. And if you have a friend who purchased Redbox stock, make sure you send them this video because I bet they would appreciate that.